Happy Monday, everyone. In this week's Macro Monday, we're going to break down the April CPI report. A lot of people are talking about how hot the report was. We saw headline inflation accelerate. We saw core inflation accelerate. But I'm going to give you one piece of information that might call into question the accuracy of those numbers. To get things started, why are we so focused on headline and core inflation right now? Well, this slide here gives us the backdrop. So obviously there's the US-Iran war that has sent headline inflation higher. That is not super surprising. Energy prices have soared, food prices have soared. What we're paying attention to is the dynamic between headline and core inflation. Are we going to see these expected rises in headline inflation flow through to core? Is it going to flow through to everything else besides energy and food that consumers are buying? And so if you look at the historical dynamics between these two relationships, you can see that in the chart on the left, these two series really trended together. So when there was supply shocks or oil shocks that set headline higher, we saw that bleed through to core. Now, if you look at the chart on the right, that relationship has not held up. Specifically, when we're talking about oil shocks, core has stayed more subdued and not necessarily tracked headline inflation higher. Now, I made an entire video talking about why this relationship broke down, so I'm not going to go into that here. I'm going to have the video pop up right now in one of the corners, and if you want to check that out, you can check that out. But there are some reasons why we might expect these two series to trend together this time around. I won't spoil it. Check out that video. But this is why we're paying attention, because it traditionally, in more recent times, has not been the case that core CPI necessarily follows headline CPI higher. So what do we see in the April report? Well, April CPI report was a lot hotter than expected. So we were expecting, if you look at the middle forecast row, or column, I should say, on the table on the right, we were expecting an acceleration in both headline CPI and core CPI. March, it was 3.3% and 2.6% respectively. And then you can see in April, beating both March and the forecast, headline soared to 3.8% and core CPI soared to 2.8%. For headline inflation, that was the highest since May 2023. In core inflation, it was its hottest print since this past September. Now, this is just one data point. What I'm going to show you on this next slide is there's a little bit of space to be skeptical of the core CPI number. And that had to do to the government shutdown in October of 2025, specifically having to deal with the shelter component. So we're going to sort of talk about this a little bit high level here, but how the CPI is calculated when you're talking about specifically rental units. They have 6 groups of rental units that rotate on a 6-month basis. So basically, the October 2025 group of rental units that they measure is then up again on April 2026, so 6 months later. So if you remember back in October 2025, there was the government shutdown. So what they did was they assumed that there was zero rent growth from April 2025 in those same apartments to October 2025. So there was 6 months there that basically were not calculated. Now, this same group of rental units was up again in April 2026. And so what we really saw was the change from April 2025 to April 2026. We effectively skipped 6 months of rent price increases that we would have seen in October. Instead, we got almost a full year of rent price increases baked into the April number. So now, why is that such a big deal? Well, shelter, specifically for core CPI, makes up almost 45% of the core CPI index. So it can have a huge sway on the number. So what does this mean? Well, if we do see a normalization in May, right? So that new set of rental units that they'll be measuring did not have the same government shutdown problem. So if we do see a deceleration in core CPI in the following month, that's not necessarily an actual deceleration in inflation. It's more of a correction of a statistical distortion that we saw in this April report. So there are basically, this is a big reason to be skeptical of the acceleration of core CPI that we saw in April, and it's due to the government shutdown in 2025. So again, this is all one data point. I would not draw too many conclusions from it. And I also wouldn't draw too many conclusions based on the month-over-month change that we might see in May, because some of this will be a correction of this statistical distortion due to the government shutdown. That's not to say that the acceleration that we've seen in inflation is not impacting the economy or people or consumers. There's a few charts I could have shown, but this is the one that stuck out to me. For the first time in, it looks like 2 years, we saw headline CPI move above private wage growth. So I've shown this two different ways. I showed the two series here on the left, where you can see the lines crossing. And then I also just showed you real wage growth, and you can see it breaking below the zero line for the first time since February 2023. Now, there's really been two stories that have been driving the market higher, generally speaking. You could say three. Earnings have been really, really strong. But the two more qualitative stories, I would say, have been on the backs of the AI investment or hype cycle, depending on your current belief in, if that story has real economic legs or not. And then as well as the resilient consumer story. So despite all of the headwinds and turbulence in the economy, the news, the war, the U.S. consumer has stayed strong. You've probably heard the line before, don't bet against the U.S. consumer. Well, part of that is for the last few years, wage growth has outpaced inflation, even though inflation has been somewhat sticky and elevated. It has not mattered. Consumers' wages have grown faster. If this dynamic were to continue to change, again, I'm going to keep saying this is one data point, it could pop back up sort of based on next month's inflation data. This would be the first real test of the resilient U.S. consumer story in at least a few years. Now I'm going to take a quick break here to just tell you guys about an event we're running. It is a live macro investing workshop with Francois Trahan. It is a virtual event on June 30th. It's a half-day event. He is going to teach you the fundamentals of macro investing. We've been running this event for a few years. We get great feedback every single year. I'm going to include a link to this event where you can learn some more information about what's covered, how to sign up, etc. in the description of this video. This event does sell out every year. We do have a open space remaining as of me posting this video. So if you're interested, I would reserve your spot sooner rather than later. It's very interactive, so we do limit the seats because we want people to be able to engage in the question and answer and be able to sort of deal directly with Francois during the event. So I think you'll enjoy the event if you enjoy these videos. Again, link in the description so you can learn more about this event. The final thing we're going to talk about is what this means for the Fed, specifically regarding to the transition from Chairman Powell to Chairman Warsh. As it currently stands, the markets have confidence that the Fed will not cut rates while inflation pressures persist. I've used this chart before. It basically tracks the implied probability by investment markets of rate cuts by the end of 2026. At the beginning of the year, it was basically split between one cut, two cut, three cuts. As you can see, there was about a 75% implied probability that the market expected at least two cuts by the end of 2026. That number has now shrank dramatically. Um, there is now, it looks like about a 5% chance of two cuts, but mostly we're looking at no cuts or potentially hikes. There's not a lot of probability of hikes at this point being implied, but it's mostly no cuts or one cut. So what this says is there's been some concerns, at least I've seen it on my social media feeds, about the independence of the Fed, right? Traditionally, when inflation is elevated, sticky, or rising, you don't see rate cuts. Now, obviously, there's some political pressure on the Fed to cut rates that thus far it has resisted, and the markets think it is going to continue to resist that pressure, at least throughout the rest of the year. And we can see that in another way when we look at inflation expectations. So quickly here on the left, we have the 5-year forward break even. What this basically says is, what is the bond market implying inflation will be for 5 years from now? So it's 2026. It's basically saying, if you go out to 2031, what will be inflation for the following 5 years? So from 2031 to 2036. Generally speaking, if there is confidence in the Fed, this number will be around 2% because that is the long-term target for inflation of the Fed. So if the bond market has confidence in the Fed to achieve their long-run mandate, this will be around 2%. And as you can see, this number has been relatively steady in between 2% and 2.25%. So again, what we're looking on the left is a market-based indicator of inflation expectations, and the market still has full confidence in the Fed. Now, is that because they don't think the new chairman is going to fall prey to the political pressures? Do they think there's enough checks and balance built into the system that even if Warsh comes in with a very dovish tone, we won't actually see any action related to that? Is it because Powell is staying on as a governor and they expect that he'll still have a very strong voice in the room, even if he doesn't have the title? I'm not sure, but as it currently stands, inflation expectations that are market-based have not risen, have not budged, have been relatively stable for years. So we look on the right, survey form of inflation expectations from the University of Michigan Consumer Sentiment Report. So this is inflation expectations in the next 5 to 10 years. This is generally going to be higher, generally going to be more volatile, as the left has a market-based component. People are actually putting their money behind this. And the right is more how people are feeling and what people expect. We can see that consumers are starting to get a bit skittish about the future. And now the concern is, again, I don't want to overstate what's happening here. It's been a slow rise, and we've seen some increased volatility in the past year or so, but it's nothing super, super dramatic. But this can start to inform consumer behavior. So if consumers expect inflation in the future, they're generally going to require higher wages. They could potentially upfront spend more money, but it is going to affect consumer behavior if they expect higher inflation in the future. So these are two things we're going to be watching, especially as inflation ticks up. How are consumers and the market feeling about expectations moving into, a couple years down the line? Thank you for watching this video. I hope you learned something new. I hope you enjoyed. If you did, I would really appreciate it if you could take a second to subscribe. We are moving very close to that mythical 1,000 subscriber number that we've been looking to hit. So if you could join and get that number a little higher, we would greatly appreciate it. All right, have a great week. I will see you next Monday here for another Macro Monday video.